Hey, what's going on, guys? It's your boy Freddy. Welcome back to the channel. In today's video, I'm going to give you guys an update to my WealthSimple Dividend Portfolio and show all of the moves that I've made since the last update. And man, have we seen a lot of volatility over the last few months. To give you a quick summary with what caused the volatility, there's a Chinese real estate company called Evergrande that funds hundreds of thousands of jobs, that owns more than 1,300 residential projects in over 280 cities. However, beyond that, they are also a very large conglomerate, owning things like soccer teams, theme parks, and does commercial construction projects as well. Recently, they have racked up over $300 billion in liabilities and made it very clear to shareholders and debt collectors that they would be unable to pay back their loans. Now the company is in a dire situation to sell off assets as well as try to get a bailout from the Chinese government, as real estate makes up 30% of the Chinese GDP. All of these concerns caused quite a bit of panic in the stock market, as it is uncertain what the global effects that the issue could have on the global economy. However, that news was quickly overlooked and the market started to recover again before dropping. This time with fears of a government shutdown, the debt ceiling, rising inflation, and the continued struggles of Evergrande, the market had continued to dip until recently the market has bounced back in dramatic fashion. Since that dip in early October, the market has soared right back to all-time highs very quickly. During this time, I've continued to chug along and add to my long-term positions, more heavily now actually, as we saw some discounts in the market. One thing I did want to mention before we get into the portfolio is going back and looking at the S&P 500. I've seen some people say that they are hoarding cash and waiting for the next major 10 or 20% dip before getting into the market, as they can get in low and ride to the highs. But taking a look at the market, if you just started to invest at that 5% dip, you would basically be buying at prices we saw in mid-July. So say you missed out on the dips that we saw in October 2020 and wanted to get in the next time we saw the market dip 5% or more, you would have missed out on over 20% gains that the market saw. This just shows how powerful the phrase time in the market beats timing the market, as even looking at the short term, hoarding and waiting for dips could have costed you over 20% in gains. For me, I saw this dip as an opportunity to simply keep doing what I'm doing, and if I had some extra funds, then to definitely buy the dip. Doing this is a proven dollar cost averaging strategy that will ensure that I'm taking full advantage of the market and all of the ups and downs that it sees. Over the last year, we've had the luxury of seeing the market absolutely explode, being up almost 40%, which is just insane. The market has been red hot and it seems like no news can possibly be strong enough to cause an extended dip. However, I of course don't expect to see returns like this every year, but nonetheless, the goal of buying and investing consistently should help us to ride out the unpredictability that we see in the market and allow us to see solid returns when we look over the long term. As some of you guys know, I've recently showcased my portfolio and dividend tracker that gives you some amazing information regarding your portfolio. You get dividend tracking information as well as some in-depth information that the brokers are unable to provide. Overall, it is a very easy to use portfolio tracker that would definitely help you on your financial independence goals. If you guys are interested in checking it out, there will be a link in the description down below. Looking at the portfolio transactions, you can see that during the market dip, I was buying almost exclusively ETFs. I added about $700 between mid-September and early October to the portfolio, and that was only in VFV and QQC. These are ETFs that track both the S&P 500, which is an index of the top 500 US companies, and the NASDAQ, which is an index that is heavily weighted in the technology sector. The reason I wasn't buying any dividend companies was not due to the lack of deals in the sector, as companies like TELUS and Ryocan saw some dips. It was simply because of the ease factor with investing in ETFs. I have been quite busy over the last month and saw that simply buying ETFs was an easy way to get into the market without worrying about trying to catch the market bottom or see if there was a good time to add to a single stock. I was able to catch a lot of the market dip with adding to these ETFs and would now look to rebalance the portfolio with adding dividend-oriented companies now. So during this dip, I added about 6 shares of VFV and 2 shares to QQC, and recently added a small position to Ryocan as well. Taking a look at the holdings from best to worst performance dollar-wise, we can see that VFV is still leading with this solid $800 gain, and Tesla, although I only have 1 share in this portfolio, is up a nutty 120% and $500, which is absolutely crazy. Although I do have this 1 share here, I personally wouldn't recommend WealthSimple for buying US stocks because there's a conversion fee of 1.5% that they charge to purchase those companies, and they don't allow you to hold US dollars, which is very inconvenient, and the fee makes it very hard to justify purchasing here. For US companies, I prefer brokerages like Questrade, as you can actually hold currency and their fees are pretty manageable as well. One company that I did want to talk about is CNR, as recently it has absolutely exploded and is up massively, especially for a dividend growth stock. I was buying this company just recently in the 130 range, and over the last month it has exploded up $30, which is both good and bad, as although I have seen a massive return, I was hoping to build out the position bigger. Nonetheless, I'm very happy to see the return, and this recent gain is due in part because of earnings and also because of the deal that fell through to acquire Kansas City Southern. I've talked in length before regarding the KCS deal, and will leave a link in the description for a video that goes over the entire situation. More recently, however, CNR's earnings were also very solid this quarter, which has sent the stock flying, which is great to see. Another company that I have on the radar is Ryocan, as I definitely want to increase my position in this company. Every month when I get that notification that there's a dividend been deposited, I want to do nothing more than increase the position further. Both September and October were excellent months for dividends, as many companies in the portfolio lined up and we saw quite a few deposits. We saw dividends from Ryocan, CNR, TELUS, QQC, Ryocan again, 2 from VFV, which I'll get into, and finally from AQN. The reason that we got dividends from VFV twice is that recently I've opened a personal account on WealthSimple, as I've maxed out my contribution limit in my TFSA. In addition to my portfolio here on WealthSimple, I have some money in a few other brokerages like RBC and Questrade, which together have made me max out my TFSA contribution limit. One thing to note is when you open up a TFSA account with multiple brokerages is that your TFSA contribution is cumulative between your different accounts. So say for example you have $10,000 in contribution limit, the max that you can contribute in total is $10,000, so you can't unfortunately have $10,000 in each account. This is something to keep in mind, as if you do go over, it can be a huge negative, as you're charged 1% per month by the CRA until you take out that amount that you've over contributed by. So what this means for the WealthSimple portfolio is that I simply now have to invest in a personal account compared to the TFSA, which won't be a big deal as it will mimic the TFSA almost exactly. Taking a look at the videos page, especially the dividend growth chart, we can really start to see the growth of our dividends over time. You can see that at the beginning we were getting next to no dividends, but slowly we're starting to see our dividends grow, and I hope that this trajectory continues and one day I have the option to live solely on the dividends. As you can see, we definitely have a long way to go before we reach that goal, but by adding in consistently to the portfolio and reinvesting everything we earn, we should reach that relatively soon. Looking at our dividend summary right now, we are receiving almost $20 per month in passive income through our dividends. So for simply holding our portfolio and doing nothing else, every month we're earning enough to pay for a premium Netflix subscription, which is really cool to see. So instead of mooching off someone, theoretically I could pay for Netflix, but let's keep reinvesting it instead for now. The dividend yield on the portfolio is 1.73%, which means that for every 100 additional dollars that go into the portfolio, I can expect to receive $1.73 back in the form of dividends. Because I have a long-term time horizon, I wouldn't want to be anything more than 2%, as I still want to take advantage of all the growth and squeeze out every dollar that I can from the market, but also earning a dividend and building out that side of the portfolio is definitely something that I want to continue to consider. On the watch list this week is of course my 1 share of VFE, which I will buy every week no matter how the market performs. And something that I'm considering is adding to RBC to the portfolio, as I want to slightly increase my exposure to the banks, as there are rumors going around that they will be increasing their dividends pretty dramatically here soon, and I want to diversify instead of being in just BNS, so this is something that I'm definitely considering. Looking at the industry breakdown, we can see that due to my ETF spending spree over the last month, the portfolio is starting to lean more towards ETFs and has gone away from my goal of having a 50-50 split just slightly. So like I mentioned with my watch list, adding some of those individual positions will start to see the distribution balance out, but honestly this isn't that big of a deal that we don't see a 50-50 split. If this leaned even 5% to either direction, it won't make that much of a difference in the long run really. With that said, you guys, thank you so much for watching through to the end. If you guys are interested in checking out the portfolio tracker, there will be a link in the description, along with the link to WealthSimple that will help you guys get on the financial independence journey. Have a great day and take care.